Good evening. The silver market is not collapsing, and it is not surging. Prices remain stable, controlled, and largely uneventful. But beneath that calm surface, pressure is quietly building. Not through dramatic headlines or sudden shocks, but through structural shifts that rarely draw attention until they can no longer be ignored. This is often how silver behaves. At moments like this, silver does not send loud warnings. Historically, it moves after long periods of silence. What we are witnessing today is not a crisis unfolding in real time, but a system slowly tightening under competing forces. Silver occupies a unique and often misunderstood position in the global economy. It is both a precious metal and a critical industrial material. That dual identity places silver at the center of several long-term global trends, unfolding simultaneously. At a time when inflation remains persistent across major economies, currencies continue to face pressure, and global debt levels are historically high, silver is being pulled in two very different directions. Investors see silver as protection against monetary instability, while industries view it as an essential input that cannot be substituted easily. This combination creates a fragile equilibrium, and fragile equilibria do not fail loudly. They hold until they don't. On the investment side, silver has traditionally acted as a hedge during periods of financial uncertainty. Unlike paper assets, silver carries no counterparty risk. It does not depend on policy credibility or institutional trust. That role becomes increasingly relevant in an environment where interest rates fluctuate, fiscal deficits expand, and confidence in long-term monetary stability weakens. At the same time, industrial demand for silver is no longer optional. It is structural. Solar energy production relies heavily on silver's conductivity. Electric vehicles use more silver than traditional combustion engines. Electronics, medical devices, data centers, and advanced military technology all depend on silver's unique physical properties. This is not speculative demand. It is functional demand. And functional demand does not disappear when prices fluctuate. It adjusts, it competes, and it absorbs supply quietly. For the average investor watching daily charts, silver may appear uneventful, even dull. There are no dramatic rallies, no sudden crashes, and little mainstream coverage. But beyond retail price movements, the picture inside supply chains looks markedly different. Refiners, mints, and industrial buyers are operating in an environment where predictability has declined. Availability is less consistent than it was a decade ago. Planning horizons are shortening, and supply buffers are thinner. Premiums on physical silver remain elevated in many regions, even during periods of price stability. Delivery timelines have extended. Smaller buyers often find themselves priced out or delayed, while larger institutions increasingly secure long-term contracts to reduce future uncertainty. These developments are not signs of panic. They are signs of preparation. And preparation always occurs before price reacts. To understand why this matters, it is necessary to look beyond surface-level pricing and examine the structure of the silver market itself. One of the most influential components of that structure is the futures market, particularly COMEX. COMEX is where paper-silver contracts are traded, agreements that represent silver exposure, but do not always require immediate physical delivery. Over time, the volume of paper-silver trading has grown to levels far exceeding the amount of physical silver readily available for delivery. This system works efficiently as long as confidence remains intact. Most contracts are settled financially rather than physically. But the greater the divergence between paper claims and physical supply, the more dependent the system becomes on trust rather than metal. That dependency introduces vulnerability. It does not guarantee disruption, but it increases sensitivity to external stress. When supply chains tighten, or when industrial demand accelerates, or when confidence weakens, pressure accumulates within the system. Simultaneously, global silver mine production has struggled to expand meaningfully. New discoveries are increasingly rare. Extraction costs continue to rise. Environmental and regulatory constraints slow expansion. Unlike fiat currency or financial derivatives, silver cannot be created by policy decision or balance sheet adjustment. Silver must be mined, refined, transported, and delivered. This physical reality places a natural limit on supply growth. Compounding this constraint is the nature of industrial consumption itself. Much of the silver used in solar panels, electronics, and medical equipment is not easily recoverable. Once consumed, it is effectively removed from the market for extended periods. This means that even when prices remain flat, underlying availability can quietly tighten. Large institutions are responding to these realities without drawing attention. Banks are managing exposure carefully. Industrial users are prioritizing supply security over spot pricing. Governments monitor strategic materials quietly, often without public commentary. None of these actions generate headlines, but collectively, they signal awareness. What matters most is not what silver prices are doing today, but how the system supporting those prices is evolving beneath the surface. Structural pressure does not announce itself. It accumulates. This does not suggest that silver is about to surge tomorrow, next week, or even next month. Market timing is rarely precise. What it does suggest is that the current pricing environment depends heavily on continued stability. Stability in supply, in confidence, and in global demand patterns. If industrial demand continues to grow steadily, if mining supply remains constrained, and if financial confidence weakens further, silver will eventually be forced to reprice. Not because of speculation or hype, but because of necessity. That repricing may be gradual, reflecting slow structural adjustment. Or it may arrive suddenly after a prolonged period of calm, once pressure reaches a tipping point. History shows that markets often move most decisively when public attention is elsewhere. Tonight's takeaway is straightforward. The silver market does not look dramatic, but it is not static. Quiet pressure is building, and balance is becoming increasingly fragile. Silver does not whisper forever. For viewers seeking context rather than noise, and structure rather than speculation, this is precisely the moment to pay attention.